5 stocks I'm buying in February 2025. I already own positions in these 5 companies, but I will be buying more shares throughout the month of February. This is always an exciting conversation to talk about which stocks are a buy in my opinion, which stocks I think will perform really well over the years to come. So let's get into it. Thanks for tuning in, guys. My name is Trey. This is Investing by Numbers. We talk about the stock market and other forms of investment. So if you're into that kind of thing, please like the video, please subscribe, and comment below if you have any questions. I respond to every comment. But first on the list here, guys, NVIDIA. I've been talking about NVIDIA for a while now. I've been waiting for NVIDIA to get below $127 a share. I picked up a very small position in this morning, and 127 a share is right at a 50 PE for NVIDIA, and I'm very bullish for anything under a 50 PE. I think NVIDIA is a good value under a 50 PE. It's got a lot of growth. They're doing great things. Of course, we had that recent DeepSeek scare that kind of got everyone a little worried, that caused this thing to take a massive drop. But that's exactly what I've been waiting for. I've been waiting for NVIDIA to take a decent drop to start building a position. So as we move forward into the month, if this thing stays below $127 a share, I'll continue to pick up shares. I'd like to pick up a lot more of this. I've only got roughly $100 in this right now, not even a whole share. But as things progress, I plan to buy more. Checking out the fundamentals on NVIDIA, they've got great fundamentals. They're a Mag 7 company, so when Mag 7 companies really get into value territory, man, they tend to go up pretty quickly. So revenue's been killing it over the past few quarters, just going up and up and up. And this isn't even counting the most recent quarter. They haven't added this into macro trends yet, and it reached an even higher level. Net income has also been doing the same for NVIDIA. They've been killing it. Same type of graph here with just exponential growth here in net income. NVIDIA's also got a fantastic balance sheet. Plenty of cash on hand. They've got almost $26 billion. And look, total liabilities are under $23 billion. So they've got enough cash on hand that will completely knock out all liabilities. I love to see that. Total assets are over $65 billion. So we've got almost 3 times as much assets to liabilities. So A+ balance sheet for NVIDIA. So when it comes to the PE ratio here on NVIDIA, here's what I kind of like to look at. The only time we've hit below a 50, that's at least recorded on this graph here. We could have hit below a 50 for a very short time period, but back in April of 2022, during the 2022 crash, we got just below 50, okay? And that was in the 2022 crash. Before that, really, I mean, we've gotten below 49 here in the past couple days, and the last time we were at that range was back in 2019. So over 5 years PE low here. So that's why I've been waiting for 50, and I'll continue to buy NVIDIA under 50 PE. Stock I'm buying number 2 is Okta. Okta is a cybersecurity company. As you can see, the stock here has been really beaten down, and it's kind of leveled out here. I like Okta anywhere under $100 a share. Right now, we're trading at around $95 a share, and I will continue to buy this thing under $100 a share. It's just had 2 quarters of profitability, so we don't have PE ratios on this yet. And when I invest in stocks that are right around profitability, maybe not quite profitable, I look for companies that are either moving into profitability or are very close to it. Obviously, over here on Yahoo Finance, we can see where the forward PE has been over the past few quarters, and it likes to be up here around 40. And past couple quarters, we've gotten down into the 20s, and right now we're just in the low 30s. So that's kind of where I like to see. I want to keep my my share price under $100 a share. The cool thing about Okta, what I really liked when I started researching this company was a few quarters ago they had a massive security breach, and it did not affect First of all, it didn't affect their stock price at all, which is great. But for the biggest part was it didn't affect customer retention, which shows that Okta is definitely doing what they need to do to keep people engaged in their services, and they're trying to move customers into more products that they offer. And so I really like that. They've got some big clients like FedEx and Wyndham Resorts. So let's check out some of their financials here. Revenue, if we're looking at growth here, they've been 400 million in 2019 up to 586 in 2020, and then to 835, and then to 1.3 billion to 1.8 billion to 2.2. They've just had massive growth in revenue. So I mean, this company should be trading, in my opinion, a 30 PE range once we get into full profitability for them. So let's just look at some of the charts here with revenue. Great, solid, increasing revenue growth over time. And when we come to net income, we can see where they have just kind of gotten into profitability here. And so here's our quarterly chart. And obviously, since 2022, we've been increasing, and the past 2 quarters have been profitable. So moving into profitability, which is really awesome, and that will show us that we have a lot of future potential gains in Okta as they move further into profitability. Balance sheet, they've got a good balance sheet. Let's see. So 2.2 billion of cash on hand, and that covers their long-term debt. We got 1.1 billion in long-term debt, which would be covered by cash on hand. Total liabilities is 3.1 billion. So our cash on hand does cover a big chunk of that, but our total assets are right under 9 billion. So we have almost a 3x here, like we saw in the video, from total assets to total liabilities. So good balance sheet there. And so with the price ratios here, normally I like to look at PE, but we're not going to have a PE ratio here because we're not fully profitable for 4 quarters yet. So we can look at price to sales. So I don't use price to sales too often, but I will use it if we don't have PE ratios. And as you can see here, right when the company went public, we were right over an 8 price to sales ratio, and of course it went way up there, up to the high 30s, almost 40. And just in the past year and a half or so, we've been below 10 and below that 8 mark that we started at, and we've been hovering right around 5 up to 7, kind of in that range. So price to sales look good. Okta's it's been really putting in revenue growth, and that net income has been flipped over into profitability. So I'm really excited about Okta, and I really like that customer retention after that security breach scare they had. That shows a lot of confidence from their consumers. So I like Okta. I'd like for it to pick up a bigger position. I have a relatively small position in it right now, but if it stays below 100, I'll continue to pick up shares. The third stock I'm buying in February is Adobe, and Adobe is a subscription-based company. It's an American software company that creates tools for digital content creation, management, and sharing. So some of the big products they have is Acrobat, Photoshop, Lightroom, Illustrator. These are great products for people that are in graphic design and digital creation online. So they have recently, they've had a dip, but they just haven't hit all-time highs after the 2022 crash. And right now, they are trading in the high 30s PE range. And in history, especially in the last 10 years, this thing has gotten down to the lowest around 32 PE. That was in 2023. And but other than that, it likes to stay above 40. Even here during this dip in 2020, 2021, we got down to 40. But lately, we have gotten down below 40. We're around to 36 right now, and I like this thing under 40. So if it stays below $490 a share, that's right around the 40 PE mark. Under $490, I'm a buyer for this company. And as you can see right here, we're at $437 a share right now. And this price goes all the way back around 5 years. I mean, it's a low from back to 2020. So we're at a pretty low price point, and the PE ratio is right for me. Let's check out their fundamentals. We've already looked at their PE ratio a little bit. But they've got great revenue growth, steady revenue growth over time. Look at this. I mean, just a steady pyramid of revenue growth, and net income's the same way. It does trade a little expensive. I mean, it has growth, between probably 10 and 15% average a year in revenue growth. So, I mean, in the 30s, and even in the 40s is a bit expensive of a price, in my opinion, but that's what it historically trades at because it's such a reliable company and it's subscription based, so their customer retention is really high. Net income, obviously we've kind of plateaued for a while, but we're still picking up steam here down quarterly here. They've got a decent balance sheet. Everything looks good there. We've got almost $8 billion of cash on hand. We've got double that in liabilities, but long-term debt is $4.1 billion. So we've got almost a double up from long-term debt to cash on hand, which is good. Total assets, $30 billion, total liabilities, 16. So we have almost 100% more assets than liabilities, almost there. So I would say a good on par, slightly above par balance sheet here. I feel good about that. And of course, we looked at the PE ratio. And as you can see here, I'll show you what I was talking about here with revenue growth over time. 11 billion to 12.8 billion in 2020. We had about a 20% move, maybe 15 to 20% move here into 2021, but then about another 10% or so into 2022, another 10% or so into 2023. And yeah, we kind of stay around that 10% revenue growth a year, but it's consistent. And like I said, the great thing about Adobe is people have been using their products, have been using them for years. I mean, decades. Even like in the 90s, my dad was a graphic designer, and he used Adobe. So solid company. They trade a little rich because people just feel that good about Adobe, and they're steady. They're not going anywhere. And so if this thing stays under 40 PE, under $490 a share, I'll be buying it. Fourth stock I'm buying is Celsius, and Celsius is an energy drink company. They've been growing pretty rapidly over the past few years, and they're just now starting to kind of go into international markets, so there's still plenty of growth in the international market. Now, we see this huge stock decline here, and this was really a supply chain issue with Pepsi. Pepsi kind of had Celsius on overstock, and their last quarter was really down revenue-wise because Pepsi kind of having the supply chain issue, trying to clear out the inventory they have. So that really kind of hurt their numbers in the last quarter, but we're expecting to kind of see things balancing out. And as we push into foreign markets, we should see a good jump in revenue, at least looking forward. So looking at Celsius's revenue growth, we can see trailing 12 months looks really good. Quarterly, obviously, this was the last quarter. We were down in revenue, and that did affect our net income. It pushed us in net income to kind of go back to a negative quarter there. So that was a little bit of a bummer, and that's obviously why we've seen tremendous downside in the stock price. Balance sheet. Celsius has an okay balance sheet. I think it needs a little bit of improvement, but for me, really just all the opportunities with Celsius and the good price point that the share price is at is why I like it so much. Total assets over 1.5 billion, total liabilities over 1.2, almost 1.3. I personally like to see 50% at least more assets to liabilities. So we're not quite there yet here. But long-term debt is almost non-existent. So it makes up for something at least. So I like to see that long-term debt is very minimal, almost non-existent. So that's a great thing there. Looking at their PE ratio, we can see here we've had some we got into profitability back in 2019, and of course hit a really steep P ratio up around 75, and then it came down to around 20 and kind of leveled out for a minute between 20 and 30. And we had a little more negative quarters there for net income, and then we kind of went up here during this real big growth cycle with Celsius all the way up to over $1,200 a share, and we came back down. And lately we've been kind of leveled off here. We've hit a high of 121, but we've been around 70 and 55, and now we're sitting in the 30s. And I like Celsius below a 40 PE. I think they've got a lot of growth left to do here, especially in the international markets. So I like it under a 40 PE. So for me, staying under a 40 PE, I really want to be picking up shares under $30 a share for Celsius. $30 is right there, just over 40, but it's a good even number there. I might consider, we have earnings coming up at the end of the month. I'd like to see what those do. I might consider buying up to a 45, but for now, there's a lot of good deals in the market. So for me right now, under $30 a share for Celsius is a buy for me. I'll continue to buy it if it stays below 30 in the month of February. The fifth stock I'm buying in February is Nike. Nike is a dividend stock. It's been really beaten down over the past couple years here. They went through some difficult times with new CEO, and they were trying to sell direct consumer and shake up their business model, and it really just did not work out for them. But now they are trying to get back on track, and Nike has just really had good numbers for a long time. I mean, they're one of those companies that they continue to raise revenues over time, even though they've been a company, since the 1960s. So like even looking here at the revenue chart, I mean, for a company that's been around since the 60s, this thing is just steadily grows, and this is since 2010. And so that's even with their most recent difficulties, we've seen a little bit of a downturn here, but basically over the last 15 years, we still see tremendous growth. Also looking at net income, same thing here. I mean, we've got a little more stagnation here with net income, but as far as trailing 12 months goes, we still see good revenue growth over time with a little bit of a decline here in most recent years. But I like that for a company that's been around as long as Nike has. I mean, a lot of companies that have been around, 50 plus years, they tend to really stagnate out when it comes to net income like that. So financials, as far as the balance sheet goes, we've got $11.5 billion of cash on hand. We have $38 billion of total assets and over $23 billion of total liabilities. And this is right around that 50% mark that I like to see. Total assets, total liabilities. We got 50% or so more assets to total liabilities, and that's what I like to see. On a balance sheet, I really like to see at least double, but I'll take 50%. I mean, obviously, I'll go below that with special situations like Celsius, but long-term debt, $7.9 billion. So our cash on hand definitely covers all the debt, which is a great metric to see. And when we look over here at the PE ratio, we can see right now we're pretty low. We're at around a 24 PE, which is fantastic for Nike. Of course, back here over 10 years ago, we kind of stayed under 20. But in the last 10 years, the lowest we usually get to is around 20. And we've seen some high points here. But, for me, like here we had around 29, right here around 29. So, for me, I like to see Nike under around that 28, 29 PE range, which that puts us around $90 a share would be around a 28, 29 PE. So for me, under $90 a share is what I would like to see from Nike. If it stays under $90 a share, I feel really safe picking up shares of Nike. It might go down, another few months, another year or so, but I think over the long term, for decades to come, Nike is a fantastic investment where it's at. Obviously, this is the max chart, and every dip here, going back to the year 2000 at least, and it goes back way further than that. But every dip has been a fantastic buying opportunity. So the fact that we're at, $77 a share, this goes all the way back, to a price back in, 2018. So historically low price here, and Nike's a brand that's got a strong moat. They're just not going to go anywhere. And so for me, it's an easy buy. This one's definitely one that I'd feel safe holding for a long period to come, especially picking it up here, under $80 a share. That's just fantastic. So that's Nike for me. It's an easy one. That's just, for me, it's an easy call. So that's it for me, guys. Those are my 5 stocks that I'm buying in February and will be buying in February. I gave you my price targets on those as far as what I'd like to see them under to pick up shares. But let me know in the comments if you're buying any of these stocks or what stocks you are buying and maybe why you're buying them. I'd like to check them out too. So if you like this video, please like it and subscribe to the channel and comment below. I respond to every comment. And on that note, we'll catch y'all in the next one. Have a great day.